Last year was an exceptionally good year for U.S. stocks. We understand that after a year like 2013, U.S. investors who didn't catch all of the upside have lingering regrets. They kick themselves for not keeping their money close to home, especially since stocks elsewhere didn't do nearly as well. For emerging markets, performance was negative for the year. Forgotten in this self-reproach are the recent lean times for U.S. stocks. Just 4 or 5 years ago, we were hearing concerns. The contrast of then and now makes for a good illustration of why we believe in the long-term benefits of global diversification. At Idaho Trust, we have spread our investment portfolios across both developed and emerging markets to make sure we don't have too much exposure to the fortunes and misfortunes of any single country, asset class, or market sector. Diversification is a key component of risk management, and investors' willingness to give up some of the positive returns of an asset or market over a given time period as a way to protect the overall portfolio during those times when the asset or market has negative returns. Many investors are less receptive to the concept of diversification when the U.S. market is soaring, but that doesn't make it any less relevant or important. There are behavioral biases that can lead investors to make abrupt and often significant changes to their long-term asset allocation in order to chase the performance of assets that have done well lately. Either alone or in combination, giving in to these biases can hurt performance in the long run. In the U.S., GDP growth for the year is forecast at 2.8%, and earnings growth for U.S. companies is projected at 7 to 8%. Taken together, this isn't too bad, but it's hard to see how the S&P can post yet another year of double-digit gains. For that to happen, we would have to have another year of major expansion of price multiples, and we don't see that as being likely. Meanwhile, emerging markets are showing signs of recovery. Since bottoming out in early February after a currency scare, emerging markets are up more than 13%. Economic growth is picking up in many countries, and the prospect of quantitative easing by the European Union could provide a liquidity boost. History makes it clear that the best investment opportunities aren't always in the U.S. After an off-the-charts 2013, 2014 could be one of those years. That's your market insights for this week. We'll see you next week.